So if you're right, it's very nice to have you here in Stockholm. You manage a big sustainable global fund. And like all global funds, there's a lot of US companies in there. Why?
Look, it comes down to the fundamentals and the bottom-up research that our platform does at JP Morgan. We see a lot of interesting opportunities there. So, within tech, for example, some of our top positions include Microsoft, let's say. So when we think about what is an appropriate investment for this portfolio, we look at best-in-class ESG credentials alongside having quality business fundamentals, whilst also being disciplined on valuation. And so when you bring that to life with something like Microsoft, we think they tick all three of those boxes. So on the fundamental side, Microsoft have positions across all of the software stack. We think that's critical when it comes to AI and taking advantage of that opportunity. So we feel very comfortable there. They're a very cash generative business. And on the sustainability side, I think there's a lot of good that Microsoft do that people don't really appreciate, particularly on the environment side, when you think about their emissions management. So they're already carbon neutral. They are, by 2030, going to be carbon negative. And incredibly, by 2050, Microsoft have pledged to reduce or get rid of all of the emissions that they have ever emitted since they began in 1975. That is something I haven't heard from any other company before. They also take sort of waste and water management very seriously. And when we think about the overall sort of management of what they do, they're really driving digital development across the world. And frankly, we think that is a sustainable business model.
There's quite a lot of tech in the portfolio, and I want to talk more about that. But from a sustainability view, are all these big tech companies okay?
No. So we have to use our insight there to really sort of understand where the differences are. I think a great example of that is something like a Meta. So we don't own Meta in our Global Sustainable Fund. That is a company where we feel very strongly ultimately isn't a sustainable business model. Now, yes, you can argue that social media brings people together and that's a good thing. But when you think about the risks that come with that as a platform, we feel very uncomfortable about that, particularly the impact that it has on young people and teenagers. That is something that we just frankly can't underwrite as a sustainable business model, and is not something that we'll be owning in this portfolio.
That's quite interesting. Let's talk about the financial markets then. You have an overweight in tech. Do you feel comfortable with that from a valuation perspective? Some of these Mag 7 names have gone quite strongly.
Yes. So it's been, frankly, an exceptional year, particularly Q1 of 2024. A lot of our positioning in the tech names did very well. We've actually recently seen a bit of a cooling off over the last few months in those names. And so if anything, we see more opportunity there. And when we think about the long-term story, things still look very good to us. The companies are continuing to spend. We're hearing a lot from those big tech companies that the risk of underinvesting is much greater than the risk of overinvesting. And so we should expect those companies to continue to spend, but they can afford to do it. Their free cash flow generation is frankly astonishing. The hyperscalers alone, I think, generate about $300 billion of cash, free cash flow. And so they can afford to invest in the AI trend. We don't think that's going away. And we still feel very good about the long-term structural growth opportunity of some of those businesses.
So you don't lose sleep worrying about an AI bubble?
Not yet. We're following it very closely. We think there needs to be patience with it. These returns aren't going to happen overnight. It could take longer than the market perhaps thinks. But we're looking for those opportunities where we're seeing companies take advantage of that. And I think a lot of it comes down to those companies that already have data capabilities within those businesses. That is where you sort of see the real opportunity come to fruition.
There seems to be an overweight with banks, financial services and healthcare in a broader sense in the portfolio as well. Any of those areas that you'd like to talk about?
Yeah, so a lot of that comes through our sort of ability to be balanced in the portfolio. So within financial services, for example, we own some financial exchanges. We also own MasterCard. We think these are very defensive, stable businesses, and that helps to offset some of the cyclical exposure we're taking elsewhere in semis, for example. So if you think about MasterCard, that's one of our top 10 positions. From a business fundamental perspective, we still think there's a long runway from moving from cash to card. Mm-hmm. But if you think about the sustainability side of that as well, that is also very positive. You know, moving to a world where you have payments with greater traceability and away from cash, there's less fraudulent transactions. And Microsoft also, MasterCard also do a lot of other fantastic initiatives with regards to communities and financial literacy that we feel very strongly about.
You exclude sectors such as gambling, fossil fuels, weapons and tobacco. Could we talk about weapons? Lately, there's been a lot of debate about weapons as a positive factor, a force for good in the world. So your thoughts about that?
Yes. Now, I can understand why that discussion has come from, and the events of the last few years have been terrible to see. But when we think about weapons more broadly, we find it difficult to underwrite that as a sustainable investment. And a lot of that comes down to the fact that it's very difficult to trace where those weapons end up. We think that, you know, the companies that are producing these weapons then find it very difficult to understand whose hands they end up in. And there's a lot of corruption that goes on within this space as well that, frankly, is very difficult for us to get any insight on. And when we think about those companies more broadly that are producing the weapons as well, it's not like their other parts of the business model is particularly sustainable. You know, it's even if weapons were in part of our sort of regular allowed areas of investment, they're not companies that we would naturally be drawn to because it doesn't really fit our view on what a sustainable business is.
Do you prefer excluding owning companies vis-a-vis actively being an active owner or a bit of an activist?
Look, we think stewardship is very important in our process, and we have a fantastic stewardship team within JP Morgan. It is definitely something that we strive to do with every company we own. But what I want to make clear here is that we're not trying to be an impact fund. This is very much a fund that is focused on combining that best-in-class sustainability, but also thinking about the underlying business quality of the company. And that's really critical to us to then think about how we can achieve long-term returns for our clients while also ensuring that we're investing in sustainable companies. And so that is our main focus of what we're trying to do in the Global Sustainable Fund.
Being a sustainable investor has been discussed a lot in the US in the last year. Any thoughts on emerging trends in that field and that debate?
Yes, I think, look, Europe has always been sort of the more forward-leading region when it comes to sustainability. I think you do have big diverging trends within the US. But I think when I think about it more broadly, the issues are not going away. You know, climate change is real. That is an issue that we need to deal with. And I think there are plenty of companies that are very aware of that within the US that we can get exposure to. The build out of the network and the energy transmission lines are very critical to everything that we're doing in terms of moving to electrification. And all of those companies are playing a critical role. So we can debate from a sort of political standpoint of different views, but the opportunity is real from an ESG perspective across all regions. And that's something that we're wanting to get exposure to.
And lastly, I know you prefer to find great companies and invest in them, but do you have any feel or thoughts about where markets are going more broadly?
Look, I think we can debate for a long time whether we're going into a recession, what's going to happen to interest rates, etc. But that's really not where our insight really is. Our insight is looking at the fundamental bottom-up stock selection. I think more broadly, we try and remain balanced within the portfolio. We're not looking to take a big macro view. But I think from the sort of top-down perspective, what we're seeing right now is fairly constructive. You know, we're not hearing anecdotes from companies around layoffs and having to get rid of employees. The labour market still feels very strong. And earnings have been holding up very well across the board. So on the margin, we're trying to be balanced, but we're quietly optimistic about the future.
Fantastic. Sophie Wright, thank you so much for coming.
Thank you.